Good morning and welcome to the Homestead CPA. My name's Dan Snyder. For those of you who've been with us before, welcome back. For those of you who are new, welcome. Today we're going to be covering part 15 of a 15-part series. So we're basically wrapping up this series today. And today I just wanted to touch on a couple of income tax savings ideas for homesteaders and summarize what we've been through with these 15 videos. If you're new to the channel, it's not important that you watch them in order. You can, but it's not required. If you see a topic that you think you'd enjoy, then take advantage of it and watch it first, and then you can watch the others that you're not sure of. But however you do so, if you choose to watch, we appreciate you being on our journey with us today. I want to start off and talk about some tax planning opportunities based around what we refer to as your accounting method. As I've mentioned in previous videos, individuals are by definition on the cash basis of accounting. And what that means is when you receive a payment for income, that's when you report it. When you make a payment for an expense, that's when you get to take the tax deduction. But there's planning opportunities. If you have had a really good year and you really don't want any additional income, let's say you're in early December, well, if you're still selling some things to people, perhaps you could get them to delay payment. Now, the payment is going to count when you receive it. So let's say that they write a check dated December the 25th, and they mail it to you, and you receive it on January the 2nd. You deposit it in your bank account the day you receive it. It's income to you January the 2nd. But let's say you had a bad year, you got a lot of deductions, and so you can afford to have income, then you might actually go to some of your customers and say, hey, I can make you a really good deal if you want to buy something here in December and accelerate some of that income that they might have otherwise spent with you, but maybe in January or February instead of in December. So keep these things in mind because they can impact your tax situation. Same thing's true in reverse for your expenses. Let's say that you had a really good year and you're trying to reduce your income. Well, if you're normally buy feed once a month, the first week of the month, well, maybe we buy January's feed in December. Maybe if we had a really good year, we buy January and February's feed in December. Take the tax deduction in the year that you have the higher amount of income. Vice versa. Let's say that you had a really bad year and you've got some big expenses at the end of the year. You don't really need the additional deductions. So see if you can't put the payments off until January. Write that check dated January the 1st and go hand it to them. Just don't give it to them in December. Now, I can already hear some of you say, well, hey, what if I go ahead and write the check, but I just go ahead and give it to them? Well, does the deduction happen in the year you gave it to them, or in the year that they cash it, or in the year on the check? All of this depends upon what your intentions are. So if you have a bank account and you wrote that check dated January the 1st and you told that customer, hey, I'm going to give this to you today, December 27th, but I don't have the money in the account, so don't deposit it until January the 1st. No, that's not a deduction because you don't have the ability to actually cover that check. You don't want to play the game. You don't want to receive a check in December and then forget to deposit in January. Oh, yeah, that was January income. No, don't go there. Honestly, there's just too many ways to reduce your income or increase your income, as the case may be, without doing something that is wrong. So we avoid those things. There's other opportunities that you have to get tax deductions. One of them we mentioned in the past concerns depreciation. And as I said, this is the thing that I get calls about in December all the time. Should I buy a new truck? Should I buy a new tractor? Should I buy a new trailer? In other words, should I buy something so I can take a tax deduction? Because my clients know that they have options. They have the option to write off the entire trailer or truck or tractor in the year they acquire it. They can spread it out over a number of years depending upon the nature of the asset. Or they may not want to acquire it in that year. They may actually want to wait, because once you buy it, it's bought, and we have to address and make tax choices. We may want to put that tax choice off into January. So these are reasons to communicate with your advisors to make sure that they understand what it is that you're doing. Now, we talked about specifically about buying a tractor. And I'm going to use the same example I did in the previous video. So I buy a tractor for $28,000. All right. And I'm going to pay $1,000 down, and I'm going to pay the rest of it off over 4 years. So I make that first payment on December the 27th. How much can I take a tax deduction for? Well, I have essentially made a payment and borrowed money, because the person I'm buying it from is carrying the note. All right. Now, what does that mean? That means while I haven't paid for it yet, for depreciation purposes, the issues are, how much of the entire asset, the entire $28,000, can I depreciate it in this year? Now, it doesn't matter that you haven't paid for it yet, because you have paid for it by taking out a loan. When you make those loan payments, there is not a tax deduction. So the principal of those loan payments is not tax deductible, because you're taking the tax deduction for the tractor through the depreciation mechanism rather than through the timing of when you're making payments. It's also important to remember that when you borrow money from people, normally they're going to charge you interest. Now, that interest is separately tax deductible. So, for example, with a $28,000 loan payable off over 7 years, the first year payments, I may have $1,500 worth of interest that I'm paying. I can take that in addition to any of the depreciation amounts that we talked about previously. So don't forget about that. Typically, you'll get a statement from a lender. If you buy it from a farm credit bureau or you borrow the money from a bank, you'll get a Form 1099 showing that. Typically, if you buy it from someone who's carrying the note, you're probably not going to get that. So you're going to have to keep track of that yourself. You can create a loan amortization schedule that shows how much of each payment is principal, how much of it is interest, and report that accordingly. So these are ways to allow you to manage your income on a year-to-year basis to a certain extent, to be sure to maximize your deductions and minimize the amount of tax that you would have to pay. The other strategy that we come across quite regularly, and let's face it, you ever watched a homesteader video? What's he got? He's got a lot of free child labor in that video. 90% of them have many children, and I'm always envious because I have to do all the work they do myself, and there's these children who are there doing the work. Now, question arises, can I pay my children for working on the farm? And the answer to that, short answer is yes. The much longer answer is as long as it's reasonable. So if I have a 4-year-old child, can I pay him for a 40-hour work week at $200 an hour? No, because that's not reasonable. If he's feeding chickens and doing manual labor, which would be paid somewhere around minimum wage, $7.25, $8 an hour, and he works 3 hours a week, could I pay him $24 and take a tax deduction for it? You betcha. The tax deduction is reducing your income taxes. So let's say that you've got a teenager, and over the course of the year, you've paid them about $8,000, and you want to take a tax deduction for those payments. How do you do it? Well, you can issue that child a Form 1099, and they would report their income for income tax purposes, file their own income tax return. Because the $8,000 is less than the, in 2024, $14,600 limit, and 2025, $15,000 limit, your child would not have to pay any income tax. However, as the recipient of a Form 1099, he would have to pay Social Security tax. You might think, I don't want to do that. Dan, you've talked about planning to make sure I don't have to pay Social Security taxes. How can I avoid that? And there is a way to do so. The way you avoid paying Social Security tax is by not giving your child a Form 1099, but actually have your business operate a payroll and the child gets a W-2. In that case, as long as the child is under the age of 18, there is no requirement for the child to pay its half of Social Security or for you to pay the business half of Social Security. So a little bit of a trade-off there. You're going to have to spend some money or time to complete the tax returns that are necessary for payroll. You have an added advantage, however, in that given that you're an agricultural industry, and you can talk to your tax advisor about this, rather than filing quarterly Forms 945, you can file one annual Form 943 and prepare the W-2s and W-3 that go along with that at that particular point in time. So it may cost you some money. I recently went through this exercise with a client, and he had 2 children that he was paying salary to, and the amount of self-employment tax for each child was about $1,000. And he said, that's $2,000 I don't really want to pay. And what would you charge me to do my W-2, Dan? And I'm like, well, I'm semi-retired, so I won't do it, but a member of our firm will. I said, and I don't know off the top of my head, but I imagine it'd be $600, maybe $800, but somewhere in that area. It's still cheaper than $2,000. And he was like, yes, can you please have someone call me? So these are opportunities that you can take. And as the child gets older and you can afford to pay them more money, it saves you more income taxes and self-employment taxes, and it doesn't cost the child any income tax. Now, here's the big problem. Dan, I want the tax deduction. Yes, my child does do the work. I don't want to put $8,000 into my child's hands because I really don't want them spending that. Well, as long as they're a minor, you've pretty much got control over that. But whatever you do, please do not succumb to well, nobody's going to know if I paid him or not, so I'll just say I paid him, or I'll pay him and I'll take all the money back. Please don't do that. First of all, you don't need to. We have other things that we can do that provide good opportunities for you and your family. The first thing that we can do is, because the child has earned wages, your child can now make deposits into an IRA or a 401k on their own behalf. So up to $7,000 a year in 2024, that child can put $7,000 a year into an IRA as long as they had that much of earnings. And you might say, that's a great idea. Why? Well, think about it. If you have a 12-year-old who puts $7,000 away into an IRA for 5 or 6 years, that money is going to sit there and grow and earn income for the next 40, 50 years until they retire. You're really going to help set your children up for a wonderful opportunity to be financially solvent in their older years. I can also hear the next question. Dan, I don't have $7,000. I can't do that. You don't have to do 7. You can do 4. You can do 5. You can do 3. Whatever you can come up with. But if gathering the cash personally is a challenge, then we have a wonderful opportunity called going to the bank of grandma and grandpa, because grandparents love to help their kids and love even more to help their grandkids. And it doesn't matter where the money comes from to go into the IRA. And so, for example, the $7,000 that the child earned could be sitting in his bank account, but grandma and grandpa could make a gift of $7,000 to the child, and that cash could go into the IRA, leaving the $7,000 that you paid in the child's checking account. Now, I'm not saying you can't ever use that money that belongs to the child. Times get tough, you may have problems, and you may need to borrow that money temporarily. What I am going to tell you is, A, always make sure you pay it back, okay? Because the best way in the world to get audited by the IRS and to lose an audit is to show that you were basically paying fast and loose with the rules. So keep the money, but the child can use that money to pay for things that aren't their ordinary and necessarily living requirements. So for example, let's say you had a child, I'm thinking of a number of different YouTubers, who's decided they want to have a horse. Well, mom and dad don't have to pay for the horse out of their own pocket because that's not something that is required. And you could tell the child, you want the horse, okay, that's coming out of your money that's in your bank account. And the child can pay for the horse, pay for the saddle, pay for the riding lessons. And so that's an effective way for you to provide the things you want for your family in a tax efficient manner. It saves you taxes. It gives you possibility to do some planning, not only for yourselves, but for your children, and basically use the opportunities that you're given. As in all the items that we have discussed over the last 15 videos, keep good records, make sure that you've got things up to date, you don't get behind, and ensure that you communicate with your advisor before you do these things. So if you're going to make payments to your children for labor, talk to your tax advisor before you do it. And he may have some suggestions as to different things that you can do, when to make the payments. Maybe you don't make them at the time of the labor is being performed. Maybe you make it at the end of the year. Maybe your tax advisor isn't comfortable with the 943, but offers the opportunity to make a fourth quarter payment where you only have to pay a single quarter payment and file a single quarter's return along with your end of year forms. So these are ways that you can show your tax advisor that you're trying to be creative, that you're trying to minimize your tax. And many times that will actually incentivize your advisor to do a better job for you because he knows that you're trying, and so he's going to want to try and help so that he can help you do even better. Just in summary, I want to thank everybody for being with us over this time period and these different videos. I hope that you have found some or all of these things to be of use. I am planning on doing at least one more video, not part of this series, where we go into bookkeeping in some detail. And I'm going to spend about an hour actually going through creating and maintaining a set of books and how you might do that for your homestead. So remember, you're only required to pay the maximum amount of tax that you're required to pay by law, but we all have to pay our share. We just don't want to pay any more than our share because, as you may recall, even Jesus paid taxes.